Central Bank Governor Sanusi Lamido Sanusi has highlighted the loss of revenues from oil theft as one of the several fiscal issues that needed to be tackled urgently as Nigeria wades through a global economic downturn. This after the MPC shocked the markets yesterday as it tightened monetary policy by raising the cash reserve ratio for banks from 8% to 12%. CNBC Africa's Wole Famurewa caught up with Governor Sanusi and started by asking about the key considerations of the MPC.
There are very dark clouds on the horizon, and if you go back a few weeks ago, we had a close shave. Oil price looked like it was just heading down and never going to turn back up, and we already started having pressures on the reserves. We started having a reversal of capital flows. All companies stopped selling, and we were lucky. Oil price went back up. So the first thing that comes out clearly is not just so much what's happening in the world, but how vulnerable we are to what happens in the rest of the world. And I'm not sure that if we do not build up those buffers, we'll be ready to absorb the shocks that will come from Europe and America and from slowdown in oil demand. So for us in MPC, we can't do anything right now about growth. We can't do anything about the structural reforms. We can't provide power or infrastructure. We cannot provide security. And these are all issues that need to be addressed by government. But we can try to get the economy better prepared for what happens. And then you've got inflationary pressures. I know people say, well, 12.7 to 12.9 is not a major uptick. But what you've got to do is look at core inflation. And that has been growing very fast. It was 14.8% in May. It's over about 15.6% in June. We project that in July it will rise to over 16%. And given that our primary mandate is price stability, we've got to make sure that while everything else is falling apart, inflation also does not. So we have to ensure that we are prepared to keep inflation within manageable limits, and you cannot afford a situation in which the existing pressures that we have from fuel subsidy removal, from new tariffs on wheat and rice, from new electricity tariffs, we can't compound that with imported inflation from a weaker exchange rate, and therefore this is really the best we can do. Try and.
I think the decision today really highlights the need for fiscal consolidation by the government again, and there's a sense that more needs to be done from the central bank.
Well, we're happy with the expressed commitment of the fiscal authorities for consolidation, and certainly we believe progress has been made compared to where we're coming from. There's still a lot to be done. There are still concerns about, for example, huge revenue leakages from the bunkering in the Niger Delta. As you know, the oil minister has put a number of about $7 billion to the amount, and the president yesterday was on national TV lamenting this oil theft that happens, and it's huge amounts. And frankly, if we didn't have that, we'd probably have reserves now in excess of 50 billion. If we didn't have the oil theft, if we didn't have some of the fraud in subsidy, we'd have reserves in excess of 50 billion. We'd have a stable exchange rate, and we would not be tightening money at the rate at which we're tightening. So in a sense, it's easy to, and I'm sure banks will not be happy. And the decision was politically a very difficult one because it will have knock-on effects on yields in general because of the tight liquidity situation. But it is a decision that is forced upon us by the situation that the economy is in, and also the fear that we have of what would happen if things turn in Europe for the worse. Now, can we guarantee that Europe will be bad and oil price will fall? We cannot. But it's better to err on the side of caution.
But has the MPC considered the implications of this move on the development initiatives of the government with respect to things like agriculture and the power sector, which clearly needs financing, and at higher lending rates, that's maybe a problem?
We'll continue to work in a manner that would support government economic policy, but we'll do it in a manner that does not undermine our key mandate. And our primary mandate is to provide price and macroeconomic stability. Price stability is not everything. And certainly you need to have growth, you need to have development, and that's fundamental. And the whole purpose of stability is to create an environment conducive to growth. But without stability, there will be nothing. So it is, like I said, it's a difficult decision. I'm sure the high interest rates are not going to be pleasing to government in general, but our primary mandate is price stability, and we think that that mandate is at risk from external shocks, and we've got to prepare ourselves against those shocks, because that mandate can be undermined from the financial system, it can be undermined from the fiscal stance, it can be undermined from external shocks. Now, even if the fiscal stance is being taken care of, the external shock element is there beyond the control of the government and the finance minister, and we cannot just fold our arms and wait until it's upon us before we start responding.